Tensions between Iran, the US, and Israel are at their highest, and it is not yet known how long this war effort will last. Many speculate it will only involve the US short term amid comments from President Trump that a significant number of Iranian military bases and infrastructure has already been wiped out, most notably the Iranians' prized Navy warship. It hints at the suggestion that this conflict may only last a matter of weeks. A long drawn-out battle with the potential for ground assault can have significant effects on financial markets globally for prolonged periods, especially if the new Iranian leader, who is yet to be appointed, follows a similar regime as before. For those already speculating in the short to medium term, here are 3 questions smart traders should seek to answer about the Iran conflict. After all, most of the world's wars have been over 2 things: power and oil. Number 1. How will the war affect different markets, and for how long? The Middle East harbors some of the world's largest oil fields. A supply shock, such as military action, can quickly send the price of a commodity much higher. But this price behavior is not isolated to the energy markets solely. Despite the increased push towards renewable energy sources, we are still heavily reliant on crude oil in our daily lives, often without realizing it. Oil affects most of the goods and services that we consume as individuals, whether involved in the production of plastics, toothpaste, and paint, or in terms of how other goods are transported around the globe. Rising oil prices longer term put pressure on fuel-based businesses by increasing transport costs, low-cost airlines being a major example. An increased cost burden may not necessarily be able to be passed to consumers in higher prices, meaning profitability shrinks fast, ultimately forcing stock prices lower. Broadly speaking, equities are affected negatively due to the underlying businesses being reliant on oil that is refined into gasoline, and the effects war may have on various macroeconomic variables. Oil-producing companies that are not directly affected by infrastructure damage, such as those not targeted within the Middle East, will likely prosper, making this a straightforward equity play for retail speculators. Higher prices means their profitability can also increase going forward from lower global supply, whereas other firms, affected like Aramco, have the cost involved in rebuilding lost infrastructure. From a monetary policy standpoint, oil crises can in fact be deflationary. Due to rising prices, more of an individual's income is spent on oil as a fuel, whether directly or indirectly. As such, a smaller proportion of their income is allocated to other goods and services. The general definition of rising prices as inflation may not be applicable, since it is only focused on extreme price rises of one commodity. For policymakers at central banks, this may mean keeping interest rates low to combat the risk of deflation continuing longer than wanted. It is expected that many economic states will begin to increase their defense budgets amid rising tensions and probability of future attacks. Funding this may be through greater issuance of fixed income securities, such as gilts or T-bills. Expectations about this happening will drive up yields, which has already been seen in global bond markets, alongside the added tensions regarding growing fiscal deficits by governments. As inherently risky instruments, cryptocurrencies are said to be uncorrelated to standard financial markets. However, short-term behavior seeks to illustrate they can be used as safe haven options, alongside gold in times of unrest when investor appetite remains strong. Number 2. Who needs oil domestically? The UK has agreed deals with Saudi Arabia to import a greater proportion of its oil going forward. This deal is amid reduced extraction from the North Sea. Recent attacks on Ras Tanura, Saudi's largest oil refinery field, sparks debate regarding the longer-term supply effects, with the price of crude oil surging after the announcement. The potential closing of the Strait of Hormuz has already sent shockwaves, with the quantity of shipping vessels passing through falling by 94% in the 24 hours after the initial bombing took place. Whilst the East-West pipeline exists across Saudi, transporting across this will still create a bottleneck situation, strangling supply, and may also be compromised by Iran going forward. The attack on Ras Tanura is retaliatory by Iran, targeting key infrastructure of neighboring countries. Iran is a net exporter of oil, supplying predominantly China. Being able to service domestic demand may be a key driver within this war. The U.S. is also a large net exporter of West Texas intermediate-grade oil. Being a net exporter makes the incentive for military intervention higher. Supply shocks make exported oil more valuable, and being able to service domestic demand illustrates a lack of reliance on other nations. It is less likely for an importing country to initiate military action in this way, unless to take control of oil reserves and the land where drilling could prove fruitful. The question remains whether Trump will seek to take control of Iran's reserves and extraction capabilities after military action has been undertaken fully by the U.S. If this is true, it stands to reason that this could be a further driver of warfare by the president that goes beyond international security. As Trump had strong motivations to take control of Venezuela's oil tankers recently, it may provide the basis to continue this approach as a matter of course with other countries after conflict. Question 3. Will other countries become involved, specifically NATO? Issues have been raised regarding other nations becoming involved in the conflict, particularly NATO. A missile was intercepted by the Turkish border by anti-defense mechanisms, which was believed to be targeting British military bases. A further attack on a British base was also made in Cyprus, indicating the conflict perimeter is growing. Under the NATO 1949 North Atlantic Treaty, a single attack against one member state implies an attack against all. Under this setup, a coordinated retaliatory attack by all members is implied. Whether this will occur depends on the severity of the conflict going forward, but is still a scenario to consider. The UK government has been criticized heavily for delaying the response to their Cyprus base being targeted. If the UK formally pursues military actions, other states may feel obliged to participate, despite many stipulating their intention to remain uninvolved. Since the attacks continue to be predominantly from the air and sea, this can quickly increase the range and scope of targets compared to a solely ground-led assault. Final thoughts. The world is changing before us. Each day presents new information, which can indeed provide valuable trading opportunities if you are able to predict what will happen next. Whilst there are a plethora of opinions out there, I hope this post will help identify a few viable questions to consider about the ongoing conflict and how to trade during this challenging time. Volatility is high currently, meaning slippage could affect stop losses. On the contrary, breakout trades may perform well if going in line with the current sentiment of the market as a whole and backed by sufficient volume. War creates volatility, and volatility creates opportunities. Stay safe.